Okay. Yeah. So, good evening, friends. Good evening to the speaker, Mr. Mehul, also. On behalf of SIRC, welcome to this CPE session on the CIRP process. I would say that rather when I was speaking with Mr. Mehul, he is going to cover the tax angles on the insolvency process. So, he will not be going per se into the CIRP or liquidation or individual, all the aspects of the code and the tax angles. I think both the direct and indirect tax angles, which is actually a very evolving subject as of now. There is a small bit of jurisprudence on that, very small bit, but there have been some directions, some amendments to the various sections, both by the GST and the income tax authorities, and it is still evolving. And I think that as the days go by, as insolvency is going to stabilize, and as the practice is also going to stabilize, and the jurisprudence is going to increase, I think we'll have more clarity on this. But in the meanwhile, we have Mr. Mehul here, CA Mehul here, who's going to give us his take on this entire thing, and hopefully he'll be able to guide us through all our queries on the tax implications during the insolvency process, which as it is very complicated, and we are adding these tax matters also to it. So I'll give a brief introduction of Mr. Mehul. CA Mehul is a member of the institute and has more than 22 years of experience in the field of M&A, tax, and advisory. And he's currently with Dhruva Advisors. And prior to that, he was an executive director in the transaction tax team at EY, and was earlier with PwC and RSM in a similar role. And he started his career with Arthur and Anderson. So all the big fours have been playing a lot of role in his life, I would say. And he has advised a large number of Indian and multinational clients on restructurings, mergers, and other arrangements. And he has been actively involved in tax due diligence and international cross-border tax structuring for private equity and strategic M&A transactions, and has also been involved in reorganization of promoter family interests and family settlement arrangements. And he has also represented the buy-side strategic parties for formulating an acquisition structure and conducting tax due diligence services on various companies referred to NCLT under the IBC proceedings. I think that's a very, very enviable profile that you have with your, I would say, the cross, pollination of the various practice areas which we have. You have your M&A, you have your restructuring, you have your tax due diligence, and now even advising NCLT. I'm sure you have a lot to share with us on the tax implications on the insolvency processes. And I know handling the processes myself, what a lot of queries, doubts we have. Even though we have a regular tax practice, it is actually very difficult to extrapolate it into the IBC practice as such. So I'm sure that you're going to give us a lot of value addition. Thank you very much, sir, for accepting our invitation and agreeing to share your knowledge and experience with us. We are very honored by that, and I hope that all the members will also have a lot of takeaways from you. Thank you very much. Over to you, sir.
Thank you, Reti ma'am. I will just put up the slides. Is my screen?
Yes, sir, visible.
Yeah,
visible.
Thank you. There seems to be some, yeah, it's gone now. Thank you so much. I will straight away dive into the topic. As Revati ma'am said, I will be looking at a broad overview of the insolvency code and the IBC framework. You will get a good idea about what the whole framework is all about. And then we will move on to the tax and regulatory issues that come up in insolvency framework. And then we will move to some basic structures or how people acquire companies under IBC. As my introduction was made, I have a lot of experience around advising companies who are looking at acquiring other companies who are under IBC. So more on the buy side, I have a lot of experience, and I'm going to share some of it today. Uh, some of this you may be already aware, but I will anyways, take you through, and there are some interesting aspects here. So, as you all would be aware, the Insolvency and Bankruptcy Code is now a single insolvency and bankruptcy framework. Earlier, there were a lot of different things around RBI resolution, around SARC, around several splintered things. There was a CDR mechanism. All of that has now been consolidated into a code which is a code which has a good legal framework and which actually it has legal force which can be implemented. And we have seen over the past few years since the code has been in place that it is really effective. It is modeled on the modern insolvency codes which are prevalent, let's say in US, UK, or whatever. And of course, it has undergone several modifications based on issues that come up in the Indian context, and it has been constantly evolving. Credit should go to the IBBI, which is the Insolvency Board, for being very proactive in terms of making a lot of amendments as the code evolved, as experience was shared. There were some judicial precedents which were also taken into account by the Insolvency Board, and amendments were made. And credit also to the government for being very proactive in making those amendments. As a result, now we have a very robust code. It's a time-bound resolution process. The code has an overriding effect on any other laws. So similar to what was there in the SIC Industrial Companies Act, it has an overriding effect over any other laws. So if any other laws have some inconsistency with this code, this code will prevail. However, it does not mean that if there is something else in any other law and this code is silent, then this code will prevail. You cannot put something in the resolution plan which is in violation of other laws. So that's something very important which needs to be remembered. As far as coverage is concerned, it now includes all companies, including NBFCs, HFCs with assets greater than 500 crores. This process can be initiated as soon as a default occurs. So it's a cash flow based approach versus what was earlier a balance sheet based approach. And we have seen that that is much more effective because a single default can result in initiation of this proceeding. So companies and promoters are very conscious and careful that they don't default, and they try to manage the situation before they land up in a default, which is a very welcome situation versus a situation earlier where the whole process was sort of not followed properly, and promoters and companies were not scared to default because they knew that nothing will happen, which is no longer the case. The threshold for minimum default is 1 crore. So the small defaults by small and medium enterprises are not really sought to be covered here, which is again a good thing because you want to ensure that the small guys are not penalized because of this code. It allows lenders to come together and control the borrower. So the lenders have actually the power to manage the company, the defaulter company, through, of course, the resolution professional, so as to ensure that things don't go worse from what they were. In fact, things are at least either status quo or improve, and therefore that helps them to maximize recovery. Most actions require 66% approval of the lenders. This process provides moratorium during the resolution process. So once the NCLT admits any resolution or any company to this framework, then there is a moratorium. No other parties, creditors can proceed against the company, which also again helps to provide stability uh, to the company involved, or to the defaulting debtor. There is a clear priority of distribution which is laid out, and secured creditors are prima donna here. They are the first uh, people to get their monies back, which includes, I mean, basically the financial creditors, uh, and operational creditors, government dues, all of them rank lower. So this is the CIRP. I think ma'am did say that I will be discussing CIRP. So yes, I will be discussing it, but just an overview. So as soon as a claim is made and there is a default by a corporate debtor, the claimant or the creditor can apply to the NCLT to initiate the CIRP process. The NCLT, of course, has to satisfy itself that the claim is genuine, that there is no dispute. This is very important. If it's a disputed liability, then NCLT could reject the application. And therefore, NCLT has to satisfy itself that it's an undisputed liability or an undisputed claim. Once the NCLT admits there is a declaration of moratorium, there is an appointment of resolution professional by the NCLT and the formation of the committee of creditors. These are basically committee of the financial creditors. And then the RP actually invites, sort of, RP actually takes control of the company, and then there is a process by which through the RP, the committee of creditors actually invite uh, bids for the resolution of the corporate debtor. Once that those initial bids are sort of, and once the committee of creditors decides on what is the best resolution plan which is submitted, that is submitted to the NCLT. The resolution plan which is to be submitted to the NCLT has to be approved for the credit, approved by 66% of the creditors. If, let's say, the resolution plan is not approved, then the NCLT can order liquidation of the company. In terms of timelines, the entire CIRP has to be completed within 180 days of the admission of the application, and there is a possibility of extending it by 90 days. And the resolution plan has to be submitted at least 15 days before the expiry of this 270 days. The key aspects is that the the key aspects of this resolution plan is that the resolution has to be as a going concern, because as I said, liquidation is a separate process, and that only happens if the resolution does not happen. The key objective of the code is to resolve and revive the company, and therefore it is always that the resolution has to ensure that the company remains a going concern, which if effectively the idea is that to ensure that the business revives, the business prospers, so that it ensures that there is no adverse implications on employment, on various other things. So that's very important. One thing is that the resolution plan can contain various restructuring like mergers, demergers, sale of businesses. All of that is possible. So the content of the resolution plan is, I mean, it's very wide. You could have various things in that, and it all depends on the creditors and finally the NCLT to approve that. Once a resolution plan is approved by the NCLT, it is binding on all stakeholders, including the government. And as I said earlier, financial creditors have superior rights, including over and above the government dues. This is very different from what was there earlier in a liquidation scenario where the government dues gain prominence. And this is, I would say, the major achievement of IBC, that even government dues are lower in priority, because what used to earlier happen is that the tax litigation and all other kinds of litigation would continue, which would defeat the whole purpose, which is no longer the case. Operational creditors, which is your day-to-day creditors, are below the financial creditors. And this committee of creditors can commercially decide on the distribution of the resolution proceeds. I would now summarize the key statutory stroke judicial developments which have happened in the last few years since the code came. So of course, any new law which comes, there is usually someone or other who sort of challenges the constitutional validity. This happened in this code as well, and of course it was upheld that this is a constitutionally valid code. It's a special law with overriding effect, and provisions of IBC shall prevail over the Income Tax Act. I would just pause here and sort of say that there are several judicial pronouncements which now say that once the resolution plan is approved, then all past liabilities abate, in the sense that if the resolution plan says that none of the past litigation shall be valued at zero, as in the past litigation liabilities will not be paid, then that is binding on the tax authorities. And I'll come to that a bit later as well, where I'll explain that in a bit more detail. Very important that the moratorium under IBC does not bear action against the guarantors. So if there is a debt which is taken by the company, and the lender also has got a personal guarantee from the promoter, so while the resolution that the corporate debtor goes through, the lender could get X money or X payment, but they can still proceed against the guarantor for the balance. So that's a very important thing which has been well established now. In terms of payments to creditors, a principle that has been laid down is there has to be no disparity in making payment to similarly placed financial creditors and similarly placed operational creditors. So one cannot sort of distinguish between say X creditor I'll pay so much, but Y creditor I'll pay. That is not possible. Now, in terms of there was a case where the resolution plan implementation was not possible because the bidder did not honor its commitment. And then now, the case law basically held that a performance security could be insisted upon by the committee of creditors. They could ask for a performance security so that the bidder who has submitted the resolution plan is forced to sort of honor its commitment. On tax, as I said, once resolution plan of the corporate debtor is approved, treatment of tax and other statutory provided therein shall be binding. Of course, in most cases, it's obvious that tax dues are treated as zero, as in they are treated that there is no liability, and that is what will be binding. And whatever other statutory claims are there which are not part of the resolution plan, meaning the tax authorities have not come about and put their claims across, those will deem to be extinguished, because the way the resolution process works is anybody who has any claim against a company, including government, has to put its claim to the resolution professional, and it has to be part of the list that the resolution process has. If a particular authority fails to submit its claim, then its claim is deemed to be extinguished. And once the resolution plan is approved, the proceedings in respect of such extinguished claims cannot be initiated or continued. This is Now the law of the land, it is very clear because it is part of a Supreme Court ruling. Now we move on to structures and how do you, as a buyer, what all do you need to think about? Let's say if I'm interested in bidding for an insolvent company, then what all considerations from a tax and regulatory perspective I need to keep in mind? That is what we will cover. So, there are certain aspects which a buyer would have to keep in mind as to what happens to the tax impact. And this impact could be very, very significant, and therefore it is important to understand. So usually any resolution plan will provide that whatever are the dues paid or to be paid to the creditors, only a part of it will be paid and the rest will be written back or rest will be extinguished. Uh, of course, it depends on the bidding amount. Like in one case, the creditors got almost 100% of their dues, but that is usually not the scenario. Usually, the recovery will be anywhere between 60, 70 to 30, 40%. And therefore, what happens to the balance? That balance gets written back in the books of the corporate debtor. Now, is that write back subject to tax? It was a big question. It got resolved by the Supreme Court in the case of Mahindra and Mahindra, where they said that any such write back is not a perquisite, it should not be subject to tax. There is still some debate around whether this principle applies only to term loans or working capital loans. But yeah, I mean, more or less this controversy has been resolved and any such write back should not be subject to tax. As far as outstanding interest is concerned, which is very important because usually in a company which is defaulting, the interest would be accrued but would not be paid. Now, if you write it back, is it taxable? The answer is yes, it is taxable because earlier the interest deduction was taken and now it will be taxable under 41(1). However, if there is a 43B disallowance and the interest has not been taken as effectively as a deduction, then such write back will not be subject to tax. As far as write back of operational creditors is concerned, again, in most cases, this would become taxable and one would have to see and plan how do you manage that. One of the ways that that tax impact can be managed is usually these insolvent or companies under the IBC will also have certain assets whose value has depreciated, and therefore one can write off those assets, especially debtors or inventory. That can be written off, and that tax that can be taken as a deduction under tax, and which can act as a shield against this write back of operational creditors. So if there is a write back on the liability side, you can have a write off on the asset side and balance it out. Last bullet as far as normal tax is concerned is uh, conversion of debt or outstanding interest into equity. Now here, this is usually not taxable, this particular transaction. In fact, if the outstanding interest is converted into equity, one can even explore a deduction for that because it will deem to be paid as per certain case laws and judicial proceedings. So one can even look at claiming that as a deduction. All this I spoke about was under the normal provisions of the income tax law. The minimum alternate tax, which is actually a tax on the profits under the P&L account, and therefore it depends on accounting profits, is a whole new ball game. Of course, now with the new regime under section 115BAA, there is a tax rate of 25% and MAT does not apply. So for those companies who have opted for this new regime, MAT becomes irrelevant. But if there are companies which have not chosen this, either because of a tax holiday or there are MAT credits or because of any other reason, then MAT also becomes important. There is any write back of liabilities will hit the profit and loss account, and hit the profit and loss account on the credit side, and therefore there will be a MAT implication, which again can be balanced off by a write-off of assets or debtors, inventory, etc. from the P&L. One has to be very careful when one does just an impairment provision, because that may not be available as a deduction under MAT. As far as the last 2 points are concerned, under Ind AS, there could, if you restructure the debt, as in you say that the debt which was 100 is now 70 or 60, but the interest rate has also reduced, etc. For various such things, there is a fair valuation which is to be done, and that also has an impact on the P&L. And again, there could be MAT implications. So one has to be careful. Of course, there are structuring alternatives which we will discuss later, by which this MAT implications could be mitigated. The other important consideration are the tax attributes. So, which again becomes very important because a lot of these companies are usually loss making, and most of the times the buyers are very keen to ensure that they preserve, or these losses remain available. These are business losses, unabsorbed depreciation, UAD, as well as MAT losses. In certain situations, there could be tax holidays, which are also important. The angle here is that as far as MAT losses are concerned, there are specific reliefs in the Income Tax Act which allow that the sum of the business loss and UAD is available for MAT. Usually either business loss or UAD, whichever is lower, is available as a MAT deduction, but for IBC companies, a summation of the two is available, which is a very important relief. All of you would be aware about Section 79, and as far as closely held companies are concerned, even under IBC, if they are acquired, then the business losses of those companies could lapse. But again, the Income Tax Act has been amended to provide a relief that such Section 79 will not apply, and the losses will continue as long as the tax authorities are given opportunity of being heard as part of the process. So this is as far as the losses are concerned. As far as the losses, normal business losses are and unabsorbed depreciation is concerned, one has to be very careful when you do merger, demerger, etc. under IBC, whether those losses are available or they are getting lapsed, and how do you mitigate that? Because the normal provisions of Section 72A will apply. There is no exemption from those provisions under IBC, and therefore one has to be very conscious about those. We spoke already about relief from outstanding tax duties, so I will not repeat that. Another important point, which is right in the middle of this slide, is the deemed gift tax under Section 56. This is important because any resolution plan will involve infusion of funds by way of issue of shares or securities, or there will be a conversion of debt into equity. There could be write back of creditors, of course, and one would have to evaluate Section 56 provisions in each of these situations. Just to give everyone an example, if there is a company under IBC, and because it has been making losses, etc., its market value may be 10 or 15 rupees. However, when an acquirer infuses funds, he may infuse it at 10 rupees only. So the difference between 15 rupees, which is the market price, and 10 rupees, which the acquirer is infused, could be subject to tax in the hands of the infuser as a deemed gift tax. So again, one has to be very careful on that. Usually restructuring through a merger, demerger helps mitigate these kind of issues. There are other considerations involved in this insolvency structuring. Stamp duty. So whenever you are looking at doing any restructuring as part of the insolvency, stamp duty becomes an important consideration. And since stamp duty is a specific state subject, one has to be mindful of that and seek ways on how to structure it. FEMA becomes important if the particular company which is under insolvency has some overseas investments, or the investor, which is usually the case, the investor who is really bidding for this company is a foreign investor, then that investor will have to comply. The company also will have to comply with FEMA regulations, and one has to be very conscious about those. Competition laws, there is no exemption. Again, this is like any other M&A. When you look at IBC from a buyer's perspective, you should look at it like any other M&A, and therefore whatever affects any M&A usually would impact even an IBC transaction, and except for certain exceptions, this would comply. This would need to be complied. One box which is missing on this slide is for listed companies. SEBI regulations also apply, but SEBI has given a lot of exemptions for companies under insolvency, including exemptions from pricing guidelines on preferential allotment, exemption from making open offers, etc. And that is very important, because that enables resolution of listed companies in a seamless manner. We now move on to certain case studies. And I have first covered certain basic case studies, which is, let's say, how does a one-time settlement happen? So a one-time settlement usually happens when it is a bilateral discussion between a borrower and a lender. And the lenders and the borrower agrees that this is the amount against this particular loan which will be paid, and that is called as a one-time settlement. The borrower companies may be required to raise funds from the promoters or the investors, but it is a bilateral thing. There is no regulator which is involved, there is no NCLT, and therefore this does not involve a lot of regulatory interference. However, this does not get any of the reliefs that are there and provided under the IBC code, like tax dues are still payable, there is no relief. None of the income tax concessions apply. And therefore, while this may be simpler because this is a bilateral agreement between the lenders and the borrower, however, a lot of concessions which could be available are not applicable. What we have also seen, what is becoming very popular is the involvement of asset reconstruction companies, or ARCs. So when ARCs get involved in a debt resolution, this is again not under the insolvency code, but this is also a bilateral thing where the borrower is not involved. But this is a transaction between the asset reconstruction company and the lenders, where the lenders sell the debt, which is which is there on the books, to the asset reconstruction company. The asset reconstruction company usually works through a securitization trust mechanism, ST, and the trust is actually the entity which purchases the loans and pays a one-time settlement to the lenders. So the lenders are out. Now the securitization trust becomes the lender to the borrower company. The securitization trust is usually funded by two entities. Up to 15%, or rather minimum 15%, has to be provided by the asset reconstruction company, and 85% maximum is to be given by other investors. This enables a situation where the asset reconstruction company, while it also earns fees for managing the resolution process, it also has skin in the game, meaning if the recovery does not happen, then the asset reconstruction company also suffers losses. So they are incentivized to make the whole debt resolution work. As far as the borrower company is concerned, for them the ARC is the new lender, and they have to service the debt uh, in the normal course like they would do for the other lenders as well. Uh, we have seen a lot of times that once the ARC purchases the debt from the lenders, it enables the case study one, meaning then there is a one-time settlement which happens more easily because the borrower finds it much more easier to negotiate and to deal with maybe one ARC versus it dealing with 5, 10, 15 lenders who are generally public sector banks. So they find, so the ARC structure also provides some benefits to the borrowers that they can negotiate in a much better manner and an easier manner. The ARC is in this business of stressed asset resolution, and so therefore their income is really to buy the loans cheap from the lenders and then ensure that the borrower company pays them a much larger amount, so that is how they make their profits. Uh, of course, and ARC has a lot of expertise in doing this, and therefore they are able to guide the borrower company as well on how they should run their operations, etc., which uh, public sector lenders may not be able to do. So there is a lot of benefits to ARCs, to this structure, and that is why we see a lot of ARCs in the market becoming very successful. Now we move on to structures in the IBC process. So if suppose neither case study 1 nor case study 2 happens, then the lenders have no option but to file a claim with the NCLT for the CIRP process. And then, as I told you earlier, there are usually bids which are called for, and the potential acquirers submit the resolution process. Submit the resolution plan. One of the structures which usually the acquirers do is they form a special purpose vehicle, which is a wholly owned subsidiary which is funded by these acquirers. Uh, they uh, they fund the target company, which is the corporate debtor, and the debt, part of the debt is paid, part of the debt could be converted into equity, and part of that converted in equity could be subject to a capital reduction, which is part of the same insolvency process. So this sort of helps in reducing the capital, ensuring lenders also get some equity stake in the company. So besides cash, they also get uh, equity in the company, and then other shareholders. One of the things which I did not mention earlier is usually in the insolvency process, the shareholders, the existing shareholders of the company, do not get anything, or even if they get something, they get something which is very minimal, because they, in the priority or the flow chart of payment, they come right at the end. So capital reduction of their shareholding is usually done to enable uh, the acquirer to take complete control of the shareholding of the company, and the existing shareholders are completely eliminated. That is how the insolvency process works. So earlier when people did not understand how this process works, we used to see situations where a moment a company is admitted to the insolvency process, and moment there is some action around or some news items around so many companies are bidding for this company, then the share market price used to go up, which was actually misleading because an insolvency process usually does not result in any benefit to the shareholders. The other structure is where the debt acquirer forms an SPV and the lenders assign the debt or rather in simple words, sell the debt to that SPV. So the lenders are out of the company, they receive the money from the SPV for selling the debt, and then the SPV merges into the corporate debtor, uh, such that the corporate debtor's shareholder now becomes, the acquirer becomes the shareholder of the corporate debtor. The SPV merges, and in the process of the merger, the debt relationship which is there between the SPV and the corporate debtor or the target, because now the SPV is the holder of the debt, gets cancelled. So this is a good way to eliminate the debt. It is also very efficient from a tax and accounting perspective, because this enables cleaning up the balance sheet of the target company in a very tax efficient manner, in an accounting efficient manner. And the acquirer gets a clean sort of corporate debtor or target company, and it sort of starts on a clean slate. So this is a very popular structure which is used for insolvency processes. That is it from my side. I hope I have given you a good overview of the entire process, and I have left you with a good amount of food for thought. And if there are, of course, any questions, I'm happy to take those.
Yes, there's one question. I'll just share my screen, sir. Hope the screen is visible.
Yeah. So I think, can I answer this question?
Yes, sir. Please, please.
Yeah. So I already, sort of addressed this, but I'll address this again. So as far as pending income tax dues are concerned, as long as the resolution plan is very clear that these income tax dues are extinguished, including the matters under litigation are extinguished, and no payments are to be made against those against those tax dues, they will not be payable, and they will, they need not be paid, and they will be completely extinguished. So I hope that is clear.
So that was one question that came up in chat box, and the audience were given an option to unmute themselves, and if at all any question, they'll unmute. We'll wait for 1 minute, sir, and then we'll wind up the session, sir. And is there any other detailed presentation or something that you wish to share with the audience, so that we'll be sharing it among the audience with the recorders of the video in a few days' time. So is there any
Hello,
you can
Mr.
share?
Mehul.
Yes.
Hello,
Hello.
Mr. Mehul.
Yes, sir.
Yes.
This is Mr. I am Rao. That question was asked by me.
Yes.
Yeah.
Okay. What I want to ask, whether income tax department will represent while submitting any claims or any pending dues to the resolution professional?
Yes, they will. They will represent, and they can file their claims with the resolution professional. Not only income tax, but even the GST department could file their claims. But ultimately, it is dependent on the resolution, the person who submits the resolution plan, how he wants to treat the tax dues. And usually, the tax dues are in the resolution plan, they are extinguished. So, but
No, whether they
definitely,
come under financial creditor or operational creditor.
they
Which
are
category they will come?
they are the same status as an operational creditor.
Okay. Thank you very much.
Yeah.
Thank you, sir. Is there any other questions from audience to put forward to the speaker, or else we'll wind up the session? If there is any, you can post queries to sirccp@ica.in. We will forward to the speaker. When time permits, sir will respond. Seems there were not much questions, sir, and we'll wind up the session. Thank you so much for your time spent here, sir, in spite of your busy schedule. On behalf of SIRC, office bearers, chairman, secretary in their absence, sir, we thank you so much for your time spent here, sir. We look forward to have you for a detailed discussion on the topic or different topic on insolvency. on some other day in future in physical session also, so in SIRC. We look forward to have you in physical sessions. Sir. Thank you.
Definitely.
Thank you so much.
Definitely. Look
Thank you.
forward. Look forward. Thank you.
Thank you so much. Wind up.
Thank you. Bye.